All right, good morning, good afternoon, everyone. Welcome to this week's Pro9 Insider. Before we get started, I just want to do a quick mic check. Please type a 1 in the questions box if you can hear my voice coming through loud and clear. All right, excellent, thank you. All right. All right, so if this is anyone's first time to the Pro9 Insider, what we'll be doing is basically just kind of doing a recap of some trades that happened throughout the week, going over market conditions, things to look out for, just any general helpful tips that we can use to improve our trading. Do usually have a couple people slide in fashionably late, but that is all right with me. And for anyone who does not know, my name is Greg. I handle customer support and training here at Academy Day Trading. Here we have our basic standard legal disclaimer letting you know we will be looking at historical examples that don't really account for all market conditions on whether a contract is filled or any of that type of stuff. We're really just concerned with the examples and things to look out for. So, all right. So I think overall July has been kind of a rough month, which isn't out of the ordinary. Volume is down quite a bit across the majority of the markets. Actually fairly typical for this time of year. July and August are usually when the big slumps in the market occurs, and it kind of feeds on itself. Everyone thinks that the markets slow down in July and August, so people aren't trading as much, so of course volume goes down. There are still opportunities and some good trading days sprinkled in. YM looks quite choppy this morning, which is something I want to point out. And for the reason, even though when we look back, let's say, even despite not really paying attention to when the market opens, just as an example, and we see this all day in a market, everything's just kind of trading in a very tight range. EMAs are kind of going back and forth on top of each other, and then if we look at our blue line, just hopping back and forth around here, it does make it to an extreme, but it's still kind of stuck in here. It's not really going back and forth between extremes too often. And that should be a major sign that, the market may be a little too choppy to trade. Not trading is also a trading decision. We don't always have to trade a particular market every day, even if it's our favorite market. I know we all have our favorite markets, but I try to shy away from that type of thinking simply because ultimately I don't really care which market it is. I just care that it presents enough trading opportunities for it to be worth my while. So all right, so YM, it's been kind of like that. We had a few good runs, but usually pre-market. So we look at the YM had this really nice run pre-market, and then just kind of ends. And then once the market actually opens, we do get a couple continuations in here, a dot trend, but these are all very short runs. And when that happens, when I notice the cycles are very short-lived, I do tend to pump my brakes a bit and reassess that market. The YM was my favorite market for a time. It would be the primary one I would look at. There was a period earlier this year when it was just breaking record highs pretty consistently. I think it still has been. um, quite often, which is pretty out of the ordinary. But if you can catch those moves, you know you're golden. So I at least like to have it open and just to check it out. You know, if I look at it in the morning and it's not doing much, I'll just put it off to the side, maybe check on it once in a while. Um, but you know, I don't think that's an issue with doing that with the market. CL is another one that is typically pretty slow, but when it moves really well, and you can catch a couple good trades, and that's a better market as far as profit potential goes because the ticks are $10 per tick rather than 5. So, and also, of course, you guys feel free to ask any questions that pop up if you had a particular day you wanted to check out in a particular market. Feel free to throw that out there in the questions box. We'll go ahead and take a look and analyze it. I do want to take a look at the NQ. So NQ, similar situation, very choppy this morning. All kinds of trouble in here if we're not really being careful or paying attention to signs of chop. So whenever we start heading in, and I'm sure you've heard me say this before if you've been here, but once we get in this narrow range here where the 200 and the rest of the EMAs are converging, and this is pretty obvious chop, but something still to be familiar with. When the markets are like this, I do not like to take chances. As an example, this guy right here is a qualified continuation setup past the 200, but I mean, just look at all this right here. We have, I bet the low of these turn bars is actually the same. 58.82.75, 58.83.25. Okay, so 2 ticks off, but we can kind of see there's a really strong level of resistance right here, where we're just not pushing through. Not to mention we're in this range, and when this happens, that is like a death grip. It will really, I mean, if you just feel like taking a chance on a trade, but to me it's much too risky to enter trades like these. And of course hindsight is, you know, 2020, but we roll back a bit, and from this point, once I see the market moving down, I'm a little once I come up here and bounce off these EMAs the first time, that's it for me. That we're in chop as far as this. Usually when the price gets locked in this range, I mean, we can move out of it here and there, but we usually don't move far enough past it to consistently hit profit targets. It becomes much more risky to enter continuations. So I know most of the time we want to try to take every qualified trade, unless the market tells us, you know, with a big flashing neon sign, hey, that's a really bad idea, you shouldn't do that. So there are plenty of times where taking a qualified trade may not be that great of an idea, like when we're trading into the 200 or trading into EMAs stacked on each other. Now we can see this pattern where it just goes a little bit past and then pulls back. And so in this case, I really like to wait for a trade to win without me. I want to watch a trade. I don't want to enter it. I want to see a qualified trade hit profit target without me. And even that's not always a clear sign. As we see, we kind of get longer cycles here, but we're still trading in a narrower range. And if we look at the crosshairs just across the top and across the bottom, there's very clear resistance and support lines. So something to keep an eye on. Most of the time, I don't really care about resistance or support lines. at different prices unless I get into this type of situation. And then by that point, I'm probably sitting out of the market anyhow. So um, I just feel that when we're heading into a choppy situation like this, the caring about supported resistance lines are almost redundant. Unless you care about it later in the day, which it may become relevant, may not. Um, so again, here we do have, let's see, our first qualified trade out of this mess. And this one doesn't win. So, I mean, we can be cautious up to this point, right? We did finally move out of that range. My EMAs are fanning out. I am getting some signs of divergence on the blue line, which that coupled with just coming out of this might make me a little skeptical about this momentum. So let's say I'm pumping my brakes on that one. All right, I just have a continuation, but I haven't seen a winning trade yet since I've been out of chop. All right, there we go. Finally, we have a continuation that does hit profit target. So then, and notice I got my EMAs nice and fanned out now. Blue line above the purple line, both outside of the neutral zone. And my super trend is pretty high. So it's now things are looking much more stable compared to this previous section of very clear chop. So if I get another trade setup, I would be more eager to take that one. So fairly conservative approach, but I think it can be warranted most of the time. And it really depends on your, how risky of a trader you are. I myself am fairly conservative, but I've been bitten enough times coming out of choppy situations to know that for me, it works better just to wait until I see an actual winning trade go without me. All right, so and quite a bit of movement in NQ today. Ton of movement actually. Same with yesterday. Yesterday was kind of a hectic day, which is unusual because earlier in the week, I mean, things have just been choppy as well. So in those type of situations, you just kind of have to be a little more cautious, I guess. But it's, at times it can be hard to determine when it is more appropriate to be overly cautious and when not to be. So, I mean, there are a ton of good trades in here. A lot of, I mean, this dot trend short kind of started it off. And then just multiple momentum entries. None of these momentums seem to be really getting stopped out. We don't have back-to-back wicks, which is good. That's kind of a pattern I've been noticing over the last couple weeks is sometimes you get momentums where you get a momentum entry, then you get a long wick, and then that one will run. So missed out on a lot of that, but overall quite a bit of opportunities here in the NQ and not really any reason to disregard any of these signals. There's no signs of, no signs of chop or anything like that. Earlier here, out of the market open, there was, but not really any. There was this, but I believe there was 10 a.m. news yesterday, which may have been part of the reason for starting off choppy. I know some traders don't even take a trade for the first 30 minutes of the market, which, to me, it really is a case-by-case basis and depends how the market's been, uh, which will determine if I'll take a trade setup right out of the gate. Um, I did yesterday on the NQ and uh, took a losing trade right out of the gate, but it's uh, it's one of those things I don't always mind uh, catching a losing trade out of the gate. I know that there's plenty of trading day left, and usually there are plenty of opportunities to make that up throughout the day. All right, so let's see. So if anyone has any questions, feel free to throw those out there. I can just kind of walk through. Let's take a look at one second. All right, so we do have a surf trade. This trade is definitely my new favorite trade in, well, with Pro9 Trader. I think it's a great trade. Very high win percentage when compared to some of the other trades, even if they're around 80%. The surf trade seems to be, from our back testing, about 90%, maybe a little more, depending on what day of the week it is. But very strong trade. I usually see them at least hit profit target. So, but the thing I love about them is they give us these opportunities to hop in these counter trend runs where we don't have a fully qualified divergence reversal. And this is, from the beginning when I started with Pro9 Trader, and this is one of the things that people would ask a lot is like, well, how do we catch these moves that, we don't have an entry? And now we have the surf trade, which really lets us do that. It does take a bit getting used to spotting them. It's quite a bit different than some of our other trades that we're not concerned with EMAs at all or anything like that, just the blue line on the correct side of the purple line outside of its neutral zone, and the super trend outside of its neutral zone in either direction. So let me catch a question here real quick. Diane asks, 2 purple candles together, anything to look for? Not really that I've noticed. It's kind of been one of those things where, here we have a double momentum, but it doesn't really matter because this wick didn't come far to stop us out. So what I started noticing was a pattern where I would get an entry on this first one, and the second would come up because our momentums have 15 tick stops, and the second one would come up and it would move 16 ticks almost all the time. Anytime that happened, the wick or the tail on that bar that stopped me out would be 16 ticks. So I've actually started testing an 18 tick stop on the momentum. So jury's still out on that one. But sometimes we do need to adjust certain things. And anytime you notice something like that and want to adjust or want to test something, I do suggest doing it in sim, maybe even on market replay. And you do really have to collect a lot of data to make an accurate assessment. Even just over the period of a month isn't really enough information. I like to go at least 6 months back and test that, because there can be kind of shorter-lived patterns in the markets or short-term behavior that may only be consistent for a month, 2, maybe 3. But if you find something that overall works out better, um, you'd want it to be true for a longer period of time. And the thing with momentums that I am curious about, I just haven't been able to do enough back testing yet, is if adjusting the stop to 18 ticks rather than 15 rides over more wicks or tails and allows me to hit profit target more often, does that counteract the times where I may have, I just saw an example, a momentum right here, and I would get stopped out at 18 rather than 15 ticks? Well, I think, if we just think about it, if we can ride over more wicks and tails consistently and hit our profit target more consistently, then it's okay to once in a while get stopped out and take 9 extra ticks. It's an extra $45. It's not the end of the world when we get stopped out with an extra 9 ticks total. But if we're hitting our profit target more often, possibly catching more runners, then that really counteracts that extra 9 ticks. So something I'm still testing. I mean, 17 ticks might be good enough, but something just needs a little more investigation. So, and this also ties in. If there's anything, back to your question, Diane, if there's anything to look out for specifically with these double, back-to-back momentum entries, and not anything that I've noticed, but if I notice short-term patterns in the market that may be happening consistently over the course of a week or two, then I start to keep an eye on it and maybe a little more cautious on the first momentum entry. If I notice that, 7 out of 10 times, or 7 out of 10 momentum trades over the last 2 weeks, the first one gets stopped out, then I'm gonna try just passing on the first one, and maybe enter the second one if it's on the next bar. And this can apply to any trade setup, but if you see something that really sticks out after a while, it's okay to adjust your trading strategy to fit that until you notice that the market kind of returns to more familiar cycles or more familiar behavior. I go back to this example quite a bit, but last year there was a period where the NQ was just flat out terrible for breakout trades. It seemed like it would just not break out. And I had one member that he would, if he entered a breakout in the NQ and it didn't hit profit target in 30 seconds, he would just flatten it wherever it was at, because that's what he noticed after doing some of his analysis, and felt it was much better to maybe flatten down a tick or two than to stay in and take the whole stop. And then that lasted for 2 months, maybe a bit longer, and then eventually it just returned back to normal. Breakouts were a thing again. But that type of stuff does happen occasionally, so just keep an eye out on it. If you notice anything that kind of sticks out like a sore thumb, seems to be happening consistently, there may be something in there for us to avoid. So, all right, so since there's all these nice runs, I kind of want to go over having a plan of attack. So say I was trading in here, I took a couple hits, maybe I avoided some of these because of chop and whatever. So kind of a little sketchy morning, but say I get to this point, we have this huge nice run. I finally see a great trend. The market is returning to a really strong trend. EMAs are fanning out. So even from back here, I can be prepared. I can say, okay, well, when I get a turn bar, I want to be prepared to set up a continuation. So even far ahead of time. And then that way, I already have my assessment on this market. I can scan the other markets, see what else may be on the horizon, and then have my plan of attack so that I don't have to sit here and watch this market and wait for this to happen before I decide what I'm going to do when this happens. I can see from back here, okay, well, I'm pretty set up for a continuation. I have my 10 below my 20, below my 50. I don't care about the 200 for the continuation trade. It's better when it's in the correct order, but not required. My blue line is already on the correct side of the purple line. Purple line's outside of the neutral zone, so if it doesn't happen until I get toward the low of the day, I don't really care. And my super trend is far outside of its neutral zone. So I already have a plan of action. I know as soon as I have my turn bar that I'm going to look and do a quick double check and decide if I'm going to put in my order for the continuation. So then I finally, oh, well, I got my turn bar. Then I just want to, I may want to wait for the next turn bar to close to make sure the blue line is going to jump out. It's fairly close and will likely cross, but in these kind of cases, you may want to do a retracement, especially if you're not sure. I always follow the rule, it's better to wait. You know, if you're not sure, just wait. It's much better to attempt a retracement. We can usually grab a retracement entry. Not always, of course. And it really depends on how, again, your risk threshold. If you're more of a cowboy trader and you say, well, that I'm pretty sure that's going to cross, and you're okay with risking that, by all means, go for it. If you're more conservative, would rather wait for a retracement or try to get in on the first color bar, also acceptable. So, and with more chart time, you do get much more familiar with how far this blue line will actually go. So you can make more accurate assessments of how far it will travel when that bar closes, if that bar closes in the direction we want. So here, at this point, say I'm feeling a little aggressive this morning, so I'm going to put in my red DPI price. I'm fairly confident that this is going to cross and get to the correct side of the blue line. So now the situation changes. My blue line moved a little farther up. I can still be set up for a continuation, but now I'm much less certain of the blue line crossing and getting to the correct side at the close of that next bar if it indeed closes as a turn bar. So I may want to prepare for a continuation rather than putting my order in at the red DPI just yet. And it goes back to waiting. If you're not sure, wait. And this is definitely a point where we should wait. It is too far to be even 90% sure that it's going to cross and get to the correct side. So I would either wait for a retracement, but we have to wait for the next bar to close regardless to see what happens. So something I like to do that I find helpful for retracements, a helpful tip that someone actually turned me onto a while ago. One of our members does this. I know some people like to do the one-click order entry if you have a momentum trade. Or no, if you one-click entry if you use an automated trade management or the ATM in the DOM. But they use one-click entry for the retracement, but I find this is a bit easier for me. Ultimately, it's pretty much the same thing. But say I want to enter at 59.6275. So I guess the price isn't too relevant, but for accuracy's sake. So I want to go short at 59.6275, but I'm not sure what's going to happen. So I'm going to click my mouse wheel in here and get my order ready for the stop limit. And then all I have to do is hit the check mark, and it'll put my order in. So I want to wait for this bar to close and then see if the price retraces back above my original entry price if the trade is indeed qualified. If it's not, I'll just hit the X, be on my merry way. But if it does retrace a bit, I can often put my order in, and then as the market moves back down, it'll fill my order, and hopefully it continues in that direction and we hit our profit target. So just a little helpful tip. I find that makes it a bit easier to get into retracements, and it also keeps me more focused and active on watching the charts. So we see my first color bar plot. Blue line doesn't get there much as I expected. It's quite a bit closer now, but I may want to wait for the first color bar to plot and attempt a retracement. So after that closes, I see that it does indeed cross, and then the market continues down. And I say, great, maybe it took off and I have a runner in. I was able to get a retracement, hit my profit target. No, I'm in a runner. I'm trailing at the high of the previous bar or at the DPI price. But that's great. I've already hit my profit. I'm already in a runner. What next? Well, we're still trending short, very strong. Super trend is now outside of its extreme zone, showing us the trend short is extremely strong. Blue line still on the correct side of the purple line. So if I get another turn bar, I can be prepared to enter another continuation. I have my turn bar. Again, blue line pretty close to purple line. So at this point, I would just go ahead, put in my order at the red DPI price. I know we're right on top of the low of the day, but our purple line, I mean, the trend is just so strong, it really seems like we just hopped on a roller coaster and went off the edge, and we're going for a ride. So put in my red DPI price. Well, I was wrong in that case. An example of when you're not sure, wait, is we can't always be sure, and I've had this happen a few times where I get into an unqualified trade situation. So sometimes it works out for us. Sometimes we get stopped out. So this is another reason why I like to use that example I just showed you with the dome and waiting for, just being prepared to put in my order with a retracement. So in this case, we can get in on the first color bar. If we hopped in on the turn bar, you're a little jumped the gun a little bit. Well, in this case, it still works out for us. But I do want to stress, we do not want to make a habit of that. So again, we're in here trailing at the high of the previous bar. Again, what next? Well, here we have a few different things happening, right? So we've been at this extremely long short trend. We had a really long run that we unfortunately couldn't hop into. Can't catch them all. Had a nice continuation short followed by a second continuation short. But now I'm getting some divergence on my line, on my blue line. We're up to 8. For a divergence reversal, I need to see this be between 5 and 10 on that turn bar. That would be a divergence qualification. So my super trend is outside of its extreme zone, has been for quite a while. So we could get to that point where the market's reached its limit with this trend, and we could see a nice divergence reversal. But we could also see a continuation. So we want to be prepared for both possibilities, which is fairly easy because the divergence reversal, we do want to wait for 2 color bars to plot and then attempt a retracement. Not always possible to get a retracement, but majority of the time we can. So here the blue line resets, which means that that would no longer be a qualified divergence. So as soon as this resets to 1, that tells me my divergence reversal plan, that's off the table now. That's not going to happen. I'm not going to see a qualified divergence reversal. I could still see a continuation. But again, after this, what happened here, even though my blue line's fairly close, the purple line is pretty bloated. And when this happens, the blue line tends not to move as far. So I'm going to be a little more cautious on this entry, and I'm just going to get prepared for a retracement on the red DPI price. I'm not going to put my order in yet. Want to see what happens. So first color bar plots. All right, so I may want to be prepared for another continuation short. Didn't happen again. All right, so it looks like the market is reversing. I could still have a possible single T if I see a short turn bar, can possibly enter on the first color bar. And the reason I'd have to wait so much is the blue line is pretty far up here now. So see my third color bar plot. All right, it's getting less likely that a single T is going to happen. I do still want to just be prepared for it in case it does happen. But since we're trending long, now I want to start looking for a surf. I know this probably seems like a lot, but keep in mind that the markets don't always move that fast. So usually we kind of have time to build a plan of attack. But I do like to stress that I find this very effective because it keeps me more active in watching the charts, so I'm not taken by surprise, because I find when I get taken by surprise and I'm trying to scramble to put in an order or something like that because I don't want to miss a trade, that's when I make mistakes. And I don't want to make mistakes. I don't want the market to surprise me. I want to be ahead of the market. So I always find I like to have a plan of action for, if not directly the next 2 bars, may not always be possible, but as with these examples of a continuation, I want to say, okay, I'm going to wait for a turn bar, and that's when I'm going to put in my order, or wait for a retracement if I get a qualified trade, rather than just kind of kicking back, taking easy, just kind of watching the charts and have my feet up on the desk, and then when a trade pops up, well, I wasn't really prepared for it, and now I have to chase it. And when you chase trades, that's when we get into trouble, can make mistakes, get it wrong. I mean, it seems silly, but it does happen where, I mean, imagine if you put in your order 1 tick late at the wrong entry price, and the market only moved far enough for you to hit your profit target if you would have put it in at the correct entry price, and that does happen. So I find it's much better to kind of develop a rhythm for scanning the markets, forming a plan of attack or a plan of action for when certain things happen in the markets. And usually that'll be when we get turn bars or a purple bar. So we don't have to look out for a ton of stuff, but you just want to have an overall idea of what to do if the market continues moving in this direction, or if you can kind of put that market on the back burner for a minute and see what else is happening. So back to now that we've had our market start to reverse, Now remember, we can catch surfs counter trend or with the trend. And I simply need to see my blue line above the purple line in the correct direction that I'm looking to go. So when I'm going long, I want to see the blue line above the purple line and outside of the neutral zone here, which it isn't yet. It's very close. So if I get one more bar, it's likely that it's going to hop out. Next, I need to see my super trend outside of the neutral zone. And this is something that I think throws people off initially, is that we don't care which direction this is outside of its neutral zone. It doesn't have to agree with the direction we're taking the trade. As long as it is simply outside of the neutral zone, that is good enough for us. So I want to kind of be prepared. And lastly, I need to see a bar with a wick of some kind. So it needs to have a wick or a tail. This can be a surf, can actually qualify on a turn bar, a purple bar, or any regular color bar with a wick, regardless of how small that wick may be. If it just pops out of the range of the bar, perfectly acceptable. I haven't really noticed any correlation with the length of the wick and how strong the trade is. It just seems like a strong trade in general. So now, even though the market's reversing, where most of the time I would say, I don't really have to do anything until I get my EMAs in order, well, we do have an extra trade we can look for. All right, so now I'm well set up for a surf long. My blue line is where it needs to be. It's above the purple line, outside of the neutral zone. Super trend still outside of the neutral zone. So I can be prepared to enter a surf as soon as one of these bars forms a wick, until the point where it's no longer qualified. And there on bar 7, I finally get my wick. So I'd enter on the green DPI of this bar, still qualified, and I was prepared for it. So as soon as this drops down, I just put my order in the dome or on chart trader, and then it takes off. I get to catch a couple bars, hit a profit target, probably grab a couple extra ticks on the runner, and then I'm just waiting for the next trade setup. Then we get another reversal, and can still look for a surf here. Doesn't look like one sets up, but now again we're back in continuation territory. So do have that momentum. I would probably be a little skeptical of a momentum that late in the run, which you may not be, but I look at the 3 previous leg lengths. We had a really long run followed by a 10 bar, 14 bar, then we have another one. We're at 22 bars. And there's really not a clear way to know when too late in a run is when it's too late in a run to take a momentum. There's just no distinct way to determine that. I mean, even here I have some signs of divergence. My blue line has been diverging for 7 bars. Super trend outside of the extreme zone. So kind of looking like we might have a divergence on the horizon, maybe in a bar or two. So again, it's one of those things that's discretion. I personally would probably pass on that, and I'd be okay with it. So I feel that whatever decision you make in trading, as soon as you make that decision, just own it, be okay with it, whatever the outcome. So even if this trade goes on for 40 bars, of course I'm going to say, oh, I wish I took that trade, but that's, by that point it's too late. It doesn't accomplish anything for me, so I try not to get trapped in that, woulda, shoulda, coulda type thinking, because it's really not beneficial to trading overall. We already made the decision, passed on the trade, or we took the trade. We could have just as easily taken the trade and it got stopped out and be saying, oh, I wish I didn't take that trade. So As soon as I make the decision to pass on a trade, that's it. I don't really care what happens after that. So there's, there's going to be another trading day. There might not be any trades for the rest of the day after that, and going to happen sometimes. But there's plenty of markets to look at, plenty of other trades. So if something seems too risky for you personally and you want to pass on it, just, be okay with your decisions and don't really get caught in that, oh, maybe I should have done this, should have done that. It's really not productive for trading. So you just kind of want to stay disciplined, trade like a robot, and that doesn't mean just, you don't have to just take every trade like a mindless robot. The advantage we have over computers who do trading is that we can trade like a smart robot and make other decisions that a program couldn't, because it has to follow rules extremely strictly. It can't think outside of those restrictions. So, but as far as trading like a robot, I think more importantly is to detach your emotions from trading, which is, of course, much easier said than done, but can be done with practice. And you just have to know that over time, if you have a rough day, that just stick with it, follow the rules, and eventually you'll recover. I mean, it's not unusual to get periods of drawdown. I've had some rough days myself that were hard not to let affect me, but I stuck with it. And at the end of the day, you're like, well, that was not a great day, and it can be easy to get stuck into a kind of downward spiral and all that. But next day is a fresh day, went back at it and was able to recover. So it is entirely possible, but our mental preparedness for trading is extremely important. Taking one losing trade, if you let it throw you off, I mean, you could end up missing out on who knows how many winning trades. I mean, even if we just look at the NQ here, well, if we were taking every trade in the morning, we weren't paying attention to these kind of signs of chop here. I did catch a winner here. Well, here's a loser. That's a full stop. Okay. I mean, could have probably avoided some of these because it looks pretty choppy in here. Maybe would have caught the first one, but should be a little concerned when all the EMAs rope on top of each other like that. Another one here. Maybe I'm just feeling adventurous today. Well, I'm able to catch a profit target here. I get wicked out by this momentum. Take another 15 tick stop here. Can catch this momentum, make it up a bit. Catch another loser here. So I'm probably feeling, if I'm not trying to control my emotions, it's probably been quite an emotional roller coaster just within the first hour of the market being open. But, if you just ride over that, just ride through it, don't let the losses affect you, and I've had this happen where, someone's new with Pro9, or just trading in general, or they're not used to this type of trading strategy, whatever the reason may be, but the first trade or one of the first two trades they take in the morning is a losing trade, and they get flustered, and they start, oh, what's wrong? What did I do wrong? It was a qualified trade. Does this work? All those kinds of thoughts. Pretty normal, I think, for anyone to have, but it gets them so distraught that they don't want to pull the trigger on another trade, especially if you take back-to-back losing trades, which uh, I mean, I think everyone's done. I've done it a couple times, and it's not great. It's hard, you know. I mean, no one's going to sit there and say, "Oh yeah, taking back-to-back losing trades, no big deal." Um, I mean, it is going to happen, but they get so distraught that they sit out of the market for almost the rest of the day. And I've actually seen this happen before, where someone says, "Oh, why? You know, I'm following the rules, but I'm losing money." And I say, "Well, you know, all right, show me the trades. What day, what market are you talking about?" And they'll send me their trades. I take a look, and yeah, the first two trades, or the first trade they took, was a losing trade. And then they didn't trade for almost the rest of the day, and there were multiple winning trades, no losing trades in that period, long runs, you know, 5 or 6, and then toward the end of the day, they have finally worked up the uh, courage to pull the trigger again, and by that time, it's another losing trade. And now they're doubly flustered, and even more so because they passed up so many winning trades in between that both of those losing trades wouldn't have, I mean, you wouldn't have made as much if you didn't take them, of course, but you would have still ended positively taking all of the trades, all of the qualified trades in the day. So, I mean, having the discipline to pull the trigger when it's the appropriate time, and knowing that the odds work out in our favor over time. So even if that's not always on the same day, um, you know, usually we do see 4 out of 5 trades be winners. That doesn't mean that we're going to see 4 winning trades followed by a losing trade, or that if you have a losing trade, the next 4 trades are going to be winners. That just means that over time, it averages out to be about 4 out of 5 winning trades. So some days, and oftentimes multiple days in a row, there might not be a losing trade. And then some days there are 2 or 3 losing trades out of 6. But over time, it equals out. So while it is important to have a good daily goal and plan, we also want to look longer term over the course of a week or a month, as I feel that's a better gauge of results. Certainly not trade by trade. If you're, you know, I used to really watch my P&L as the trade and kind of sit there and, you know, cheer it on, but I find that was really not beneficial to my the psychological aspect of trading for myself. So if I put on a trade, that means I've already made that decision. Whatever the outcome is I can't control it. I have my stop in place. My stop is the most I'm willing to risk for that particular trade. So if it doesn't work out, that's okay, because I was okay with that risk before I entered the trade. What happened after that changes that. And it's probably the fact that once the order is filled, then our money is actually on the line and it's not hypothetical anymore. So I do feel that the mental aspect of trading is something that people don't usually focus on too much, but it's probably one of the most important things, because I mean, really, most anyone could learn how to identify patterns on a chart if you have examples or rules of what to look for. So that's not the hard part. The hard part is being consistent, being disciplined, pulling the trigger when you need to, actually be willing to enter the trades, and taking the risk that's just associated with trading in general, regardless of who we are. So, all right, everyone, we're down to the last 5 minutes. So if there are any last minute questions, now would be the time to throw those out there. Hopefully the demonstrations about focusing on the a plan of attack is helpful. I find that's one of the most important things about trading with Pro9 Trader, is getting into that habit. You may not have to be as active as that. I personally like to remain uh, really active when I watch the charts. It keeps me engaged uh, and focused. I can tend to get bored easy, especially if nothing's going on. So I know, I'm sure I'm not the only one. Sometimes staring at these charts is like watching paint dry, but again, we have to remain consistent um, and disciplined when watching the charts. If we're going to treat this like a business or we want to consistently make money at it, of course, if you just want to grab a couple extra trades during the day, and you're fine with that, more power to you. Um, but if you're treating it like a job or a business, um, I find that following the same routine every day, regardless of what happens in the markets, uh, is important. Because if you get in the habit of uh, maybe the markets aren't doing anything for the first couple hours, and you're like, well, I don't need to trade today. I did pretty well yesterday. Markets have been on and off slow. I'm going to take the rest of the day off, and then tomorrow, maybe you decide to do it again, and you could miss out on a lot of opportunities. But ultimately, that depends on what your uh, goals are and what you want to accomplish with your trading. So. Another thing I want to touch on briefly before we're done for the day, as I was talking earlier about, uh, testing this other stop, an alternate stop for the momentum trade that I feel might be more effective uh, using 18 ticks rather than 15. And I talked about doing enough testing to ensure that that might be beneficial over the long term. And the reason you want to test a lot is that humans are prone to something called confirmation bias. If you're not familiar with what that is, all of us do it in many different subjects in our lives, but how it applies to trading is, well, confirmation bias is basically that we seek out information that confirms something we already think is true or we already believe is already the case. So I could see this happen a couple times with my momentum trades, and I say, oh man, this whole week I've been getting stopped out by 16 tick wicks every single time. And that's good enough for me. That's how it is now. I've seen it happen. I already think that's going to happen over and over and over. So maybe I just adjust my stop to 18 ticks without doing my due diligence, and it ends up coming to bite me in the long run. And I think that happens a lot with trading because as traders, we're always looking for new patterns, new trade setups, and we don't want to jump the gun without doing enough research. You want to test, especially if it's something like a new trade setup. If you think you see a pattern, if you're not there yet, don't worry about it. I know it's pretty common for traders to constantly look for new patterns or new setups or new little details that can help stay out of riskier trades or what have you. But the point is, if you do something like that, just don't assume that if you've seen it happen for a week or you've noticed it a couple times that's how it is, because what also happens is your brain kind of filters out information that contradicts that point of view. So while I may notice more times where my momentum trade gets wicked out at 16 ticks, there are plenty of other times where it probably doesn't matter. So I may not be making the correct assumption, and I just need more information to make a better decision. So Bottom line though, do back testing if you're not sure about something. Um, Sim testing, market replay, whatever you need to do. Make sure you just have enough information to make as unbiased a decision as possible. You just want to look at the data. Does this happen more often than it doesn't? And is it beneficial over the long term to alter this little step of my trading? All right, everyone. Thank you for joining us this week on the Pro9 Insider. I hope it was helpful to you guys. Hope you're able to learn a little something extra and take that and apply it to your trading. That is our goal here. If you guys have any feedback or suggestions, as always, feel free to drop us a line at support@academydaytrading.com. We are always interested in finding ways to improve this class for our new members, as that is why we hold this. It is for you guys. So if there's anything that is not being covered or something you want to see covered a little more detail, please drop us a line and let us know. I'd be more than happy to incorporate some other information into these classes that, if it would be helpful to your trading. So again, thank you for joining me. I hope everyone has a wonderful rest of your day. Hope the markets treat you well for the rest of the day. Have a great weekend, and until next time, happy trading.